Hello, everybody. I'm just gonna check on the voice and make sure we are live. I'm not hearing any voice here, so. Hello, everybody. I'm just gonna check on. Okay, so we are good. What I want to talk about today. Today is Sunday. I hope everybody's having a good time and enjoying your family and all that. This is just for educational and entertainment purposes only. I want to talk about the gaps and about morning trading in general, okay? If you follow this concept, it will definitely change your trading in the open in many, many ways. So, what you want to do first is look at the SMAs. I keep my chart simple. I don't trade nothing else but the 8 SMA, the 21 SMA, and the 200 SMA. So if you look at your stock in the morning and you see it in a tight range, that's what you want. You want those three with the SMAs as close as possible. Okay, we're going to be talking about how to trade the gaps. Okay, and what happens when the stock gaps up or gaps down. How should you check it, look at that and see how can you trade that basically. So the way you do it first, if you want to have more odds, okay, if you want to have more odds of the stock working for you and that trade gonna work for you, you need to look at few things. Okay, so let's say like these are extremely flat, so you go ahead and you just put a line right here and you put a line right here at the lowest point. Okay, so we know they are in a tight range, and you wait, 7:30 opens up. If the stock opens up here, if you see a big bar right here like this, a green bar takes out all this, okay, you don't trade the first minute. This is a 2 minute chart, so you let the first minute roll and you wait and see what happens. When the 2 minutes is finished and it shows you like, hey, this bar have taken everything else right here, okay, that's your signal, okay, to go long if you're above the 200 and above the SMAs. Okay, if you want for more confirmation, like if you want to make sure like this is correct, what you can do also, you can wait till like the 20 is hooking or rising up and you can take it. You see how the 8 is rised up, and then you have this, it went up 3, and then you have this red bar right here. You can wait for more confirmation and take this leg here. That would be leg 1. That will be the pause, and that will be leg 2. That will give you more assurance that this played. The minute you see one red here and you see the 8 is rising and the 21 is rising, you just take it long for leg 2, and you see the result. Because whenever you're coming from a tight space and a lot of accumulation, the stock will continue going up. So let's say something else happened where like the stock gapped up here. That was the open right here. So you still take this one long. You still take it long. You don't get scared if it's open here. But if it opens like right here, okay, it depends on the stock. If you see a powerful bar and it's strong, or it pulls back and this, it gets holded by the SMAs and it surpassed this one, you might enter it again. But if it's way up here, you want to be cautious. And then you can still take it long, by the way. This one you can still take it long because everything is above, the momentum is up, everything is up. There's power behind this bar. You just got to fill this up like you think of it as a green bar. But you might want to wait like if you see this huge bar, let's say, you might want to wait for a red bar and put your stop right here and then, take your charge. But you don't want to like risk $3-4 or $1 if this bar is huge. You don't want to take it. You want to wait till this bar is finished and see if it gives you like a red dot, like a little doji, and you take it you take it long. The other scenario is like if the stock open up in the morning where it opens up here, like it opens way up here, and it just opens right here. This one right here, you do not, basically you don't want to trade it. If you're like new and all that, it takes a lot of professionals. There's three scenarios can happen, okay? Everybody woke up in the morning and they just found out this stock is, my God, man, I bought this stock yesterday or 3 days ago or a week ago, and it gapped up to here in pre-market, okay? So I'm in profit, like $3, $4. So I really don't want to take, you don't want to trade this, because this guy here is full of money and he's happy and he is selling as fast as he can. So three things can happen when a stock gap excessively. One thing, it might drop like a little bit like this and continue shooting up, but it will stay right here and it'll be like choppy, okay? The second scenario you will see, like, and it tricks a lot of people, is like it would go up a little bit, but nothing will happen, and it will just keep go. It will go down again, it'll go up again, it'll go down again, and it just dips, but it will stay in that area. Or the third thing would happen is like it will, like you will buy it right here and it will just dip hard, okay? They keep just selling it and selling it and selling it. And the third thing, if this only happens if the gap is extremely excessive, okay? Like way up there. You don't want to trade that one at all or do nothing with it. This is what happens in like a $5 or $6 or $12 or $13 gaps. Okay, the stock have moved the daily range and maybe an extra 10, 15 bucks or whatever. There's good news and all that. You don't want to mess with this stock. Either buy it for long term or short term or anything. All it's going to do is just going to be like a flag like this. It's going to create a flag and it's just going to be floating in space. Like when you see it excessive like this, you're going to think, oh man, it's going to push hard down. It might push down a little bit, but most of the time it will chop like this. And it will just keep chopping and chopping and take all your money. Oh, let me short it again. Let me take it long. But the stock is already tired. The stock is like hammered. So you might want to let it go for 3, 4, 5, 6 days. Don't even bother looking at it. And wait till maybe it will start going down and fill up this empty space right here. That's basically it, guys. That's how you trade the gaps. But like I said, very important in the morning. If this is this is very important. You want a tight accumulation right here. You want a tight accumulation as hard as possible. You want the 21 SMA, the 8 SMA, and the 200. You want them as tight as possible, as close to each other as possible. Okay, and you want to break through either to the upside or either to the downside. If the breakthrough to the downside, you want to make sure for a confirmation, like red took out green, and you just wait. You don't let this bar fool you. You wait, it can shoot back up. So you wait for the 2 minutes to finish. If you get a little doji here and it confirms down, yes, you take the play, you take this play right here, and you put your stop right here. Okay, you put your stop right here. Oh, like let's say this way, the bisque, just drop your size, and this will give you a better chance of it working out, because it might shoots up and it shoots down and it shoots up and shoots down. But eventually, if it stays below this here, we're going down. If it goes up, you're going up. So both ways work. But like I said, the same thing for the gaps. If it gaps up here, possibility it might shoot back up. You see how stocks tends to like to trade, like come back to a narrow range and then fires up from a narrow range. They come to a tight range and then they fire up. So when you are here, possibility that this thing is just going to shoot back up, okay, to a certain degree. So it's excessive gaps. But if you gaps here, no, there's the possibility is down. We're going down, okay? We're not going up. So that's how you trade the gaps. If it even gaps here, you're still betting short, okay? The more odds are bet you need to bet more short, and you need to bet more short. But way down here, no. You go short here, man, you're gonna eat it, because the moves are gonna be shallow, small, and then like spikes up. Why? Because it's away from the 200. It needs to go back. It needs to go back where it needs to be. That's basically it, guys. We trade live every day. Paper. We're doing that paper challenge for 30,000, where we're trading live every day. When the market opens, we probably stay open for about an hour, hour and a half. We do live trades right in front of you, and we're trying to make it 30,000. We're doing it on paper. The reason we do it on paper is for everybody to practice, and there's nothing wrong with trading paper till you get your strategy. As long as you be very strict and not be lousy with yourself, and be very strict on your setups, your risk management. The only way you can think and follow strategy when you are not under stress. But if you're putting live money on the line, okay, I've been doing this for a long time, guys. And if you're putting money on the line, it's extremely hard to learn trading because you're stressed out. So you put your stop, be comfortable with your stops all the time, and try to make it to $25,000, $30,000, and try to focus on 2 to 3 strategies and just follow your trading plan. Follow your trading plan, but do not be lousy or like, my $200 stop, I'm going to take my $200 stop. No matter what happens, it hit my stop, I'm going to take that. And keep looking at your, write your trades down and look at your like overall. Do not look at trades as one by one as, hey man, I lost one, because this game you lose trades and you win trades. You lose trades and you win trades. So you don't want to be focused, oh my God, I'm a failure, I lost one trade. Most professionals, their batting average, which is like win rate, is between 42 to 32%. But if you do the math right, you can, if your math is right, and these people are still profitable, if your math is right, you need to understand the math behind this game. It's not about just bars and entering and exit. If you understand the math behind it, you become aware of what's going on, and you don't waste years and years you're doing everything backward, okay? You have to make sure, all you have to do is look at your losses. Control your losses. You need to control your losses. My method of trading is like 99% of the times I try not to lose more than 1 bar on every trade, okay? I try not to lose more than 1 bar. If I lose 1 bar, yes, that's fine. And it's like not a huge bar to like this bar is like $3. I go ahead and enter a $3 bar just for the hell of it, and I'm down like, 300 shares, and I'm down $900 on 300 shares. No, you want to, like, within your risk, if it's a $3 bar and you really like the setup, there's nothing wrong with entering 100 shares or 50 shares. As long as you're risking 1% of your account all the time, you're going to be ahead and losing 1 bar, but like, try to win as many 2 to 1, 3 to 1. You will never, if you do the math on these plays, you will do phenomenal. Anyway, I'll see you guys on Monday. I hope this is something that you guys gonna gain some knowledge from. It's pretty simple concept, but extremely powerful. And it just try to look at it like, go on paper trading or simulated trading and look at these gaps and see when, like, try to see this narrow range right here and see the gaps where it happens right here or right here, or is it didn't gap at all, which is good right here. Okay, you just want it to go either this way or that way. But excessive gaps, stay away from, basically. All right, thanks everybody. Hopefully we'll be, please like and subscribe, and I'll be live Monday trading the paper challenge. You know, the paper quest to 30,000. We're starting with 100,000. So far we're up $3,183, and we'll see how it goes. Everybody have a good Sunday. Enjoy your weekend.